A GAAP rule exists that requires companies to value their inventory correctly at the lower of cost or market. So this is an end of the year adjusting journal entry. Now in accounting principles, you were given the cost and you were given market, so you just had to determine, what is my adjusting journal entry? Do I need to adjust my inventory down and record this inventory write down? In intermediate accounting, you're given the cost, but you have to calculate what market is. And again, you have to make the adjusting journal entry. But once you know the terminology, it's not that difficult. You have to determine what designated market is, and the terminology will be ceiling, replacement cost, and floor. The floor is that net realizable value minus a normal profit. It's just a little bit different under IFRS. Designated market cannot be more than the ceiling or less than the floor, so you're going to take a middle number of those three. And again, this is required by GAAP. It should not be valued higher than the benefit the inventory can provide. That's why you have to make this adjustment. And it does follow the rule of conservatism. You record the loss in the period the value declines instead of waiting and selling it at a lower cost. Lower of cost or market is a departure from historic cost. And by applying the lower of cost or market, this is to material write-downs of inventory. So the ceiling, that's the net realizable value, which will be calculated. You'll be given sales price. You'll be told what is your disposal cost. So you need to calculate what ceiling is. Replacement cost is an estimate. It will be given to you in the problems. You don't have to make the estimate. It cannot be higher than the ceiling or lower than the floor. And the floor is net realizable value less a normal profit. Now, it's a little confusing because it says it cannot be higher than the ceiling or the floor. What we're talking about is the designated market cannot be higher than the ceiling or the floor. But when you're looking at the numbers, these three numbers, sometimes replacement cost given will be higher than both your ceiling or the floor, or it could be lower. You're simply going to take the middle of these three numbers, whatever that is your designated market. Okay. It must fall between the floor and the ceiling. Then you compare designated market to cost. So think of this as two steps. You're going to first determine what market is, and then take that number and compare it to your original cost. And you can apply it in three ways. So GAAP says you have to do lower of cost or market analysis, but you, the company, get to decide, am I going to analyze this on an item by item basis, or different categories of inventory, or the entire inventory? And you can change every year as long as you're doing the overall lower of cost or market analysis, and adjustment if required. And two different ways you can record it. It's your choice. It's your company. You can put it in a loss on reduction to LCM account, or you can put it into cost of goods sold. And now this is going to affect your multi-step income statement, because if it's in cost of goods sold, it's above gross profit. If it's recorded as a loss account, it's down in other income and expenses, down on the bottom of your income statement. Some companies, instead of reducing inventory, they want to track things a little more. They have another account set up called an inventory allowance. And that is how you do the lower of cost or market.